John Ulzheimer is known as one of our nation's most recognized credit experts. Having worked for 28 years in the credit industry, John has become one of the most prolific speakers about credit and the go-to authority on answers to credit-related questions. Credit Countdown with John Ulzheimer.
Hey there, this is John Ulzheimer. I am a consumer credit expert. I have almost 30 years of experience in the credit industry. I've spent time with FICO, which is the company behind the FICO credit scoring system, and Equifax, which is one of the 3 generally recognized credit bureaus in the United States. And so today we're going to talk about the different types of credit scoring models that are in use in the credit industry. So generally speaking, there are 2 brands of credit scores that have about 100% of the market in the U.S. financial services system. VantageScore, which is a product of all 3 of the credit reporting agencies. So VantageScore is actually owned by all 3 of the credit bureaus. And FICO, which is obviously A, my former employer, and B, the FICO score is obviously the property of FICO, the company, which FICO is an acronym, Fair Isaac Corporation, FICO, FICO, get it? And FICO is a publicly traded company. They're not a division of any of the credit bureaus or anything like that. They're a freestanding, independent company that's actually publicly traded. So you could actually buy stock in FICO if you wanted to. So those are the 2 generally used credit scoring systems in the US. And when I say generally used, I mean to the tune of over 20 billion scores a year, which is like 3 times the global population. So there's just a massive number of credit scores are calculated every single year under those 2 scoring brands. There are different types of credit scores. So people always talk about, well, my credit score is 750. Well, that's one of your several dozen credit scores. So no one has just a credit score. Everybody has a gigantic number of credit scores. There are credit scores that are what are referred to as generic scoring models, meaning that they're like Play-Doh. You can kind of mold them and put them in any particular lending environment you want, and they're going to fit just fine. So there are generic scoring systems built by FICO and VantageScore that can be used for mortgages, auto, credit card, student loan, boat loan, motorcycle loan, personal loan, whatever. And those models are very, very commonly used. There are also what are referred to as industry-specific scores, and an industry-specific score is a credit score that's used by a particular industry because the model itself is semi-customized to be more predictive for that particular type of account than it is for some other type of an account. Well, let me give you an example, and it's easier to explain with an example. Let's say that you are an auto lender. So you run a lending company, and you only do auto lending. So you care about how people pay their credit cards, but you really care about how people pay their auto loans, right? Because that's the type of money you're lending. You're lending money for autos. So you really want to make sure and feel comfortable that the people that you're lending money to are going to pay back their auto loans and have a history of paying back their auto loans. There are credit scores that are customized for auto lenders. So FICO has one called the FICO Auto Score. It's still a FICO score. It's still 300, it's actually higher than 300 to 850. It can actually go up into the 900s. But it's specifically tuned for auto lending to predict the risk for auto lending. And so this is an example of an industry-specific score. FICO has several of those. They have bank card scores. They used to have mortgage, personal finance, and installment. Those models are not generally used any longer, and actually FICO in the newer generations of their scoring systems has sunsetted those variations. And so the 2 most common types of industry-specific scores that FICO builds are going to be the auto score and the credit card score. So it's called the bank card score, but really it's for credit card issuing. In the insurance environment, it's very commonly known that insurance companies use credit reports and scores. What's not commonly known is what type of score they use. So there is this myth, if you will, that insurance companies use credit scores. That's a little bit misleading and not really true. Insurance companies use insurance credit scores. They don't just use credit scores. And so a credit score that Bank of America would buy for auto lending or for credit card issuing is not the same type of credit score that some insurance company would use to underwrite an insurance premium. So, or an insurance policy, and use it to set the premium. So they're both based off credit reports, but one of them is obviously tuned and built specifically to predict insurance risk. Are you likely to file a claim? Are you likely to be an unprofitable insurance customer? Those are the types of things that insurance companies care about more than, say, a bank would care about. And vice versa. So a bank is not going to use an insurance credit score because they're not in the business of underwriting insurance policies. So those are some examples of kind of generic scoring systems which can be really used by anybody for any reason versus these more specific scores that are more powerful for that particular type of lending and specific for a certain type of extension of credit. So if you have any other questions about insurance scores or any type of industry specific scores, drop them in the comment section below and I'll do my best to get to them. It was a pleasure speaking with you. We'll talk again soon. Have a great rest of your day.
For more videos and credit tips from John Ulzheimer, go to www.tradelinesupply.com.